Um, okay, real quick. So for people who don't know, the 60 Decibels Microfinance Index is an annual initiative that's been running for the last 4 years. We look to use this to collect data from direct borrower voices across the globe to measure and compare the social impact of microfinance institutions based on this feedback from their clients. All 4 years of the index have offered a look at client outcomes, trends in financial inclusion, and how financial service providers are evolving to better serve their clients, grounded in this direct feedback. This is the launch of this year's index. It's been out for a couple of weeks. We hope you all have had a chance to read it. But we wanted to take this opportunity to talk through the insights that we see emerging from the report this year, and also hear from some of our partners and FSPs who are on this call with us in terms of how this data is sort of helping them serve clients more effectively. Just in terms of a quick agenda for this session, we'll do a quick round of introductions that I'll just go through, and then we'll dive straight into the report from this year, ranging from how our sort of overall survey is set up, and then just going through the insights that we're seeing. Once we're done with that, we'll do a short panel discussion for which we have three wonderful panelists who I'll just introduce in a second. And then after hearing from them quickly, we'll open up for question and answers so that we can hear from you, our audience, in terms of what sort of questions are most pressing on your mind. And then between us on the panel, we can respond to all of that. Now, just in terms of quick introductions, I'm Atul Sukumar. I work at 60 Decibels as the lead of our microfinance work. I've been working in financial inclusion, livelihoods, and gender over my career in the dev sector, and I'm excited to get this started. Now, onto our panel, we have Calum Scott, who is the Global Impact Director at Opportunity International. He is responsible for social performance management across Opportunity's global network, which develops innovative financial services, loans, savings, trainings, and partners with financial institutions to reach low-income clients across the globe, working with everyone from micro entrepreneurs, families, and farmers across the globe to break sort of the cycle of poverty. Next, we have Lebogang, who is a senior strategy and innovation analyst at Small Enterprise Foundation, which is a microfinance institution founded in South Africa, and one of our award winners for this year, which we'll get into in a second, which focuses on providing group loans and business education to low-income women in South Africa as a pathway out of poverty. Finally, Cynthia, who is a manager of social performance management at BRAC Liberia. BRAC Liberia works to empower people through microfinance, youth education, livelihoods, and agricultural programs to people who are excluded from mainstream financial systems, with a focus on women living in poverty in rural and hard-to-reach areas of the country. That's a quick intro. I know that's a lot of information. Again, if you have any questions at any point, please feel free to drop them into our Q&A. Now, just as a quick background of the kind of data we'll be talking about this year. As I'd mentioned, each edition of our index offers a look at client outcomes, trends in financial inclusion, and how FSVs are evolving. Each year, we consistently represent around 15 to 20% of the global microfinance market. Over the years, we've partnered with over 50 leading investors, 400 plus financial service providers. This year, this report that we'll be speaking to today captures insights from about 25,000 clients across 39 countries and 85 FSPs. And overall, our benchmarks that we speak to throughout our reports and work captures voices of over 120,000 borrowers over the last 4 years across 400 plus FSPs. Now, the way we look at our microfinance index work is to assess the impact, experience, and satisfaction of clients across several different dimensions. The key dimensions in this work is understanding access, so whether underserved clients are being reached, whether they have alternatives, the impact of specific loan products on the things that they're designed to impact, so things like educational outcomes, housing outcomes, and business outcomes, household impact, which is what is the nature of household impact experienced by these clients, ranging from changes in their quality of life to things like savings, savings, healthcare, education, etc. And then on the sort of more critical aspect of things, client protection. So understanding how microfinance is serving these clients is important, but we also want to see whether these clients are experiencing a repayment burden, whether they understand the terms and conditions of the debt they take on, and their experience with things like harassment or unexpected loan fees. Finally, to understand the sort of softer aspects of the impact microfinance has, we also look at things like changes in resilience. So whether the impact experienced by these clients then translates to stronger financial resilience over time, and also then changes in agency if clients are better able to exert decisions over different aspects of their lives, not just financial, but otherwise, and also, sort of the softer aspects like improved confidence, etc. Outside of this, we do also have several add-on modules that we'll cover in some of our insights, ranging from things like climate resilience to child lens investing, it's understanding the impact on children in a household, housing, and others. Now, before I jump into the insights for this year, I want to just take a minute to call out the winners of our awards for basically social impact in the Microfinance Index. We have two of them represented on our panel today. But outside of that, we'll just put a link in chat that you can use to go through and see what these top performing financial service providers are, not just for this year, but also for previous years. But yeah, these are just some of the organizations that have done exceptionally well based on the data that we hear from their clients. Okay, now on to the meaty stuff. Now, before we dive into the new insights from this year, we just want to take a second to look at the data we've seen across all 4 years. There are a few things that we know that show up consistently. We know that microfinance financial service providers are consistently reaching first-time borrowers. Underserved populations are more likely to access formal financial systems as a result of microfinance. We know that microfinance's core thesis holds, which is that productive income-generating loans drive superior outcomes across a lot of measures, not just in the short term in terms of things like business impact, but also at a household and other level. This year, we've driven into this further to also understand how non-productive use loan products work, but this is something that's remained consistent across the years. Thirdly, we know that group lending models continue to remain particularly effective for microfinance, not just in terms of client outcomes, but also in terms of reducing the risk in poor client protection outcomes that experienced by borrowers. So group lending is effective both for customers and also for financial service providers. Fourth, we know that despite all the good things, repayment burden remains a persistent challenge. These borrowers are experiencing quite high impact. However, there are still segments and sections of these borrower populations that experience high repayment burdens, financial stress, and this remains core in sort of both our analysis and in the sector's priorities as a whole. Next, what we do know is that it is not just loans that are catalyzing impact. We see that organizations that provide additional services, clients who have access to additional services, be they savings, financial trainings, etc., report higher impact. And so additional services sort of work well with credit to increase the impact experienced by populations. And this is, again, something that we dive deeper into over the course of this report. And then finally, again, sort of calling back to the core thesis of microfinance, we know that it is not just that income is improved, but that the resulting outcomes, such as improved financial management, improved savings balances, drive improvements in resilience, and bring borrowers to a place where they're able to exert their agency more effectively. Finally, we know that there is a gendered lens to microfinance. Women tend to report stronger outcomes across the board, not just in terms of, again, financial outcomes, but also that things like agency, their ability to make decisions independently, and overall their ability to engage with livelihoods and sort of overall household outcomes improves through engagement with FSPs and microfinance. We know this. If you go through the report, we also talk about how the trends in data have changed, but yeah, this is just something we want to lay out up front. Now, diving right into the insights. The first thing that we see this year that's quite interesting is we added a question around whether clients are planning to take their loans or not. Effectively, whether the loan products that clients are accessing are planned or if they're driven through emergencies and unplanned. So what we see is that clients who report planning their borrowing are nearly twice as likely to invest in their businesses. It is important to note that this doesn't mean that non-business loan usage is unplanned. Non-productive loan use products are equally likely to plan their utilization. But what we do see is that clients who plan their borrowing are likely to report significantly stronger outcomes across almost all measures. They are likely to have a better quality of life. They're likely to have increased savings. They're likely to have improved ability to manage finances. This is likely because they're more likely to align their borrowing with cash flows and income-generating opportunities. And this, we think, demonstrates the interconnected benefits that characterize successful microfinance interventions across the board. However, this at the same time is not to say that emergency borrowing is inherently a bad thing. And while clients with unplanned loans are significantly more likely to report that repayment is a burden and increase financial stress, we think this highlights a critical concern because emergency loans do help clients address urgent needs. They provide immediate relief for a lot of these borrowers. Oftentimes, borrowers taking unplanned credit are likely in some financial crisis already. What we think this highlights is the importance of paying more attention to these borrowers because adding repayment obligations to somebody who's already in a position of financial stress can exacerbate that stress and also create the risk of accumulating a debt burden that can then deepen financial challenges. We think this data shows us that FSPs play different roles for these types of borrowers. For planned borrowers, we're able to enable strategic goal achievement. We're able to support deliberate investment that drives long-term financial improvement. For unplanned borrowers, FSPs provide that crucial emergency support to address immediate needs. But these borrowers require that careful attention and may benefit from anything from additional diligence during the underwriting process, additional financial counseling, and maybe emergency-specific product design to mitigate that risk. Because currently they are risking over-indebtedness as well. Moving on to our second insight, and this sort of calls back to the point we made about additional services. The data is stark this year. We see that the most vulnerable populations benefit the most when credit is combined with additional services. We define vulnerability as clients that say they would have the most difficulty coming up with funds to cover emergency expenses, and they represent almost a quarter of respondents in our survey. We see that this vulnerability has a significant impact on loan experience and impact. They are likely to face repayment difficulties than non-vulnerable clients. When you look at those that struggle with repayment, vulnerable clients are almost twice as likely to report they simply cannot afford the debt that they've taken. And when we look at impact outcomes, these patterns hold. Fewer vulnerable clients report improved quality of life. More concerningly, almost 1 in 10 vulnerable clients report that their situation has actually worsened since engaging with their FSP or taking on that credit, compared to just 1% of non-vulnerable. And when we look at the drivers of this deterioration, we see that debt affordability is a primary sort of theme that comes up often. Along similar lines, financial stress reduction and savings outcomes, which are both sort of core benefits of effective microfinance, remain limited for vulnerable populations. Around 13% actually see their savings decrease due to accessing this credit, which is, honestly, quite a stark difference from non-vulnerable clients, where only 2% report the same. Now, encouragingly, the data shows that this is not a lost cause, so to say. Additional services beyond credit significantly improve outcomes for vulnerable populations. Vulnerable clients who access additional services report dramatically better quality of life outcomes, superior savings performances that are comparable to non-vulnerable clients. What we think this evidence demonstrates overall is that vulnerable clients do achieve strong outcomes from microfinance, but their more challenging starting point often requires additional support to unlock this potential. So FSPs that offer these additional services, be they financial education, savings programs, even insurance, are often much more effective at bridging the gaps that are faced by these vulnerable populations, and thus dramatically improving outcomes. This also then allows these clients to transition from sort of crisis management to more stability building, which, as we've highlighted earlier, remains a core thesis of microfinance. Now, third, this is a topic we dove deeper into this year, which is specifically digital delivery of microfinance. It has been an increasing thrust in the sector overall. And we see drastic differences between clients that access loans purely digitally versus those who are accessing credit through in-person or sort of hybrid approaches. Users of digital-only services consistently report poorer results than other clients. This ranges from satisfaction of their experience with their FSP, but also measurably lower impact outcomes across key metrics, including quality of life, understanding of loan terms, and critically, like client protection metrics. They're likelier to report harassment and to experience unexpected fees. Now, this becomes particularly concerning when you sort of tie this back to the earlier points, because our data shows that digital services are increasingly used by clients who have urgent financial need. Nearly 1 in 3 of the clients that take unplanned loans are accessing and repaying credit through digital-only channels, compared to about 1 in 5 of planned borrowers. Now, again, these are borrowers that are already in vulnerable financial positions, and even outside of that, the importance of clear loan terms, transparent payment structures, and overall positive experience is extremely critical for preventing financial distress, which is something we've seen from data across the years. We do see that this is not all bad news. Like I said, There are segments that do slightly better. We see that group loan out clients report similar quality of life outcomes across service delivery mechanisms. There is some peer support inherent in these different lending methodologies that provide some protection against the negative effects of the reduced personal interaction of digital services. However, there are still protection vulnerabilities that exist. But this isn't bad news. What is interesting is that hybrid service approaches seem to be the optimal approach for balancing efficiency with client protection and outcomes. We see that hybrid clients report, excuse me, the highest understanding of loan terms. They maintain strong client protection metrics, and they achieve satisfaction and impact levels that are much closer to in-person services than digital-only delivery models. We think the data suggests that the sector and FSPs as a whole don't need to choose between efficiency and client protection. We can effectively pursue both just through thoughtful service design that combines the digital convenience with strategic human interaction touchpoints. And we will be diving deeper into this in future editions of the index to understand where those touchpoints are that in-person interaction creates the most sort of impact. Now, on to the fourth slide. Now, we've already talked about the importance of understanding loan terms and the impact of that on things like protection and impact. What we see is that there is a very strong impact evident to explaining loan terms clearly. Simply put, the likelihood of experiencing a repayment burden almost doubles in the absence of a clear understanding of loan terms and fees. And with a quarter of clients reporting that repayment is a burden, this is a critical protection gap that we can address effectively through better communication. This isn't just a function of client protection. This also translates directly to client satisfaction. Clients that don't understand their loan terms are likely to experience repayment burdens, and clients that experience a repayment burden report dramatically lower satisfaction rates than those who don't, with an NPS of 35, which sort of demonstrates the correlation between loan term understanding, repayment burden, and then negative experiences with their FSPs, and also lower quality of life. Like I said, impact is also a relationship here. This is particularly pronounced around segments of clients that are already struggling. So, PAR 30 clients are more likely to disagree that they are able to understand loan terms, which is obviously translating to them later repayment difficulties. The evidence is unambiguous. Transparent, well-communicated loan terms is the foundation of client protection, and FSPs that are prioritizing effective communication are not just improving understanding, they're helping clients reduce their burdens, enhance the satisfaction, and just overall build a stronger loan portfolio. So this is one of the most actionable and effective interventions we see for improving both client outcomes and the financial bottom lines of FSPs. Now, we also went deeper into harassment this year, and we see that one of the biggest gaps that remain in the sector is awareness of complaint processes. We see that nearly 1 in 10 clients experience harassment from FSP representatives across our overall sample, but only a quarter have reported these incidents. Among those who didn't, over a third just simply didn't know how to file complaints. Around 30% didn't want to report these incidents. So there is an environment of reluctance and confusion that happens around reporting in certain contexts, which is undermining our sort of overall commitment to client protection. We see that a lot of this has to do with knowledge gaps. Clients who find loan terms clear are likelier to not experience harassment. And similarly, those who understand loan terms are also likely to say that they knew how to complain versus those with lower understanding, which suggests that clients who are struggling to understand basic loan obligations are also struggling to navigate protection systems. There are some differences here. Individual borrowers, urban borrowers are likely to experience harassment. There is also a regional difference. While African borrowers are facing the highest harassment rates, we see that the differences for not reporting tend to vary. Asian borrowers are most likely to cite unwillingness, in contrast with African and Latin American borrowers who are most commonly attributing that to institutional gaps, i.e. just not knowing how to report. Overall, we think these findings reveal that effective client protection requires both robust systems and comprehensive education. So 3 key areas. 1 is making complaint processes widely known and accessible. 2 is addressing cultural barriers to reporting in different contexts. And 3 is ensuring that basic client education includes rights awareness alongside financial education. Now onwards, we dove deeper into the gender angle this year, and we see differing patterns in how women and men experience the impact of their microfinance loans. So women report dramatically higher quality of life improvements and satisfaction. However, the more revealing thing is the fact that while women are more likely to use loans for business purposes, the perception of value that they report seems to come from immediate family needs. So increased income is top of mind for both genders, but women are much more likely to report an improvement in quality of life due to their ability to cover household expenses going up or to afford education for themselves or their dependents. We see that there are fundamentally different approaches to how the genders measure loan success. Women pursue increased income, but evaluate outcomes through household welfare improvements, while men see value primarily in their ability to increase business investment in assets. This also translates to emergency resilience, which suggests that women are often starting from a position of greater vulnerability and thus achieving stronger resilience improvements, which supports that initial hypothesis that more income results in better budgeting and saving capabilities, which combined with this improved access to funds creates a financial security that enhances their ability to cope with emergencies and their overall financial independence. And understanding these sort of household-oriented strategies and loan use behavior creates opportunities for tailored financial products that can then even further enhance the household impact of these loans. Now, on to our last two insights. I know I've been talking for 15 minutes. Don't worry, you guys won't have to put up with me for long. We'll go to our panelists soon. So like I said, we looked at non-productive loan use products this year. And what we see is that while microfinance's core impact thesis holds, which is that productive use loans lead to positive outcomes across financial well-beings, and it is a good best practice, we shouldn't be disregarding the value of non-productive use loan products. They just work through a different pathway. So simply put, if you have a productive use loan, you're significantly more likely to report financial improvements, so increases in savings, financial resilience, ability to manage finances. However, non-productive use loan clients, while reporting lower financial improvement gains, continue to report significant improvements in their quality of life. It is comparable across groups, and in fact, non-productive use loan products, in this case, we were looking at education and housing loans, are much more likely to report significant improvements in their quality of life, with over half reporting very much improved versus only about 34% of those with productive use products. Now, this is not to say that the sector's concerns around non-productive use lending aren't valid. The data validates some of these risks. Non-productive use loan clients are likely to report repayment burden, likely to experience increased financial stress. But what we think this tells us is that these loan products are delivering meaningful value through different impact pathways. However, there are elevated risks that come as a result of these loans not being attached to income generation, which requires deliberate product design, careful underwriting, and potentially different pricing structures to make sure that clients are protected while these loans are delivering value. Finally, onto those modules I quickly mentioned. So first, we looked at child lens investing, which is specifically to understand the impact of microfinance products on children and households. 2/3 of our respondents had children under 18 in their households, and microfinance has a significant impact on outcomes. So over 52% of caregivers report improved outcomes on everything from school attendance, which is perhaps expected, but to also report more positive impacts on areas like improvements in meal quality and healthcare access. We think this is likely a function of different investment priorities amongst households with children and without. On a similar note, caregivers are also likely to not view loans as burdensome, suggesting there's a stronger loan tolerance among families. So targeting outreach and product design to create value for these households with children, where we have demonstrable multiplier effects, can allow us to sort of deepen impact and improve the health of our loan portfolio simultaneously. Finally, when we look at climate resilience, climate change is top of mind for all of us. The data from this year's work shows that 44% of respondents experienced a climate shock in the last 2 years. Rural communities often being disproportionately affected, with over 64% of those affected by climate shock being from rural communities. Interestingly, we see that rural clients also report slightly greater preparedness for future crises, suggesting that there is an aspect of exposure driving adaptive sort of capacity development. Similarly, these segments of clients also report different approaches to adaptation and resilience. Now, what we think this tells us is simply that these different segments are both experiencing different natures of events, but also reacting to them differently. And in positive news, almost half of clients reported that access to their microfinance loan reduced the severity of climate shock they experienced, which demonstrates the role of microfinance in building climate resilience. Fundamentally, we think this sort of underscores the impact of understanding the specific nature of vulnerability that exists, what the coping mechanisms these clients already use are, because understanding whether it's water scarcity or flooding or temperature extremes can allow us as the sector to enhance climate resilience by developing sort of targeted products that align with existing strategies and address sort of location-specific challenges. Overall, we think what both these modules show is that household characteristics are as important as loan product design in the impact outcomes experienced by clients, and that FSPs who recognize this are often better able to serve their borrowers. I know that was a lot of talking. Like I said, you can go through all the insights for this year in our report. And also, if you want to dive deeper into any of this data, we have a platform called Signal that we've launched recently that houses all the data across FSPs in the Microfinance Index, and we'll just be putting a link in chat. That is my presentation, so I'm just going to stop sharing for a second, and we can move into the discussion portion of this. I know I'd already introduced all our panelists, but I'll just, as I ask them questions, just ask them to quickly sort of speak through their role and their organization before sort of moving to questions. So now jumping straight into this. Calum, hi, welcome, like I said. Now, Opportunity International supports many FSPs globally. And you have been a sort of longstanding partner for us in our index work. So we wanted to hear from you on what stood out to you in this year's Microfinance Index findings. And also at a broader level, we'd like to hear from you on how you use client level data, like from the MFI Index, to inform your funding decisions and your strategy. Over to you, Calum.
Thanks, Atul, and thanks for the chance to join the webinar. Just as a quick introduction to myself, I've been with Opportunity International for many years now as Opportunity's Global Impact Director. As Atul touched on, we're a long-standing investor in and supporter of microfinance. We have a particular focus on low-income groups, education finance, agriculture finance, and increasingly building up a health portfolio as well. And we've been a partner in the Microfinance Index since the start. So we've had around 10 of our microfinance partners participating each year. Happy to say we've had 2 award winners in the last 2 years. But as I'll explain, that's only part of the value for us participating. In terms of this year's results and what stood out, I mean, the first thing I would say is, for us, the power of these survey findings is that they cover tens of thousands of clients. So, we have our own sources of intelligence around how our programs and partners are performing. But we can't tap into that level of data. So it's really, for us, it's a chance to see what's happening in the sector, what's happening to microfinance clients, and what are the key trends that we should be aware of. So Atul, you mentioned the hypotheses that 60 Decibels are testing. We have our own global theory of change, a global theory of change for opportunity, and that drives our programs, how we choose our partners, where we choose to invest and expand, and other aspects of our strategy. And we put a lot of emphasis in our theory of change on the importance of additional services alongside just the financial products themselves. So, for example, training, providing training to clients, or market information would be good examples of the additional services that we support. And our theory of change, emphasizes that this is critical to building resilience in clients. And we're also committed, as I said, to expanding outreach to lower income clients and the most vulnerable. So we were very interested in the second of the key findings in the report, that the most vulnerable benefit most when credit is combined with those additional services. You spoke about that in your introduction. It's especially interesting because, from the data, what was found that outcomes are actually weak for those vulnerable households when they're only receiving credit. So in a sense, it backs up what we've learned from our experience. Opportunity has 40, 50 years of experience in delivering microfinance through partners across a very broad geography. But even though this isn't news to us, there's a real value add in being able to point to this year's report and the fact that robust, extensive data supports and reinforces our assumptions around that. Additional services can be expensive to provide. They can require subsidized funding. So it's really important to us that we can show how those services are adding value, especially for those lower income clients that we're trying to serve. So that's one example I would give of what we found interesting and useful in this year's report.
Thanks for that, Calum. Yeah, I think that really sort of validates our approach to sort of uncovering these additional nuances that contribute to impact. Just as a note for the audience, if you have any questions on what Calum has just said or any of the things that I just spoke through, feel free to drop your questions in the Q&A box below, and we'll get to them in a minute. Now, just sort of moving to Lebo from Small Enterprise Foundation. Hi, Lebo. Like I said, please do introduce yourself as you sort of get into your response to this question. But our question to you was, as an impact-first financial service provider, how do you use impact performance data to provide a sort of competitive advantage to yourself? And relatedly, sort of dovetailing off what Calum just spoke about in terms of theory of change and stuff, how do your impact-focused investors support you in navigating financial performance alongside impact performance?
Thank you. Thanks for the question, Atul, and hi everyone who is participating. So as I mentioned, my name is Mahlalela. I work in social performance at the Small Enterprise Foundation. So we are a developmental microfinance. We've been operating since 1992, and we currently operate in 7 of the 9 provinces. We have a little over 170,000 clients, so we are South Africa's biggest developmental microfinance institution with a vision to free the world of poverty. So how we do that is that we offer a range of financial and non-financial services. We also have a financial education program for Decibels. So some of the key impact metrics that we use within CEF is firstly our progress of poverty index, and that just gives us a sense of the poverty within a household, and we're able to then track that change over time to see if we are in fact making an impact on our clients and to prove the social impact that we're making within the household. We also look at other things like client satisfaction, clients of business, clients of exit. I just want to ask Atul, can you please just drop the question in the chat box because I'm struggling to hear you.
Yes, absolutely. Just give me 1 second.
No.
Okay, you should have it now.
Right, thank you. So I'll first answer the first one, which is as an impact first FSP, how we use impact performance data as a competitive advantage. So I think similar to Calum, CEF does collect a lot of impact data. So a lot of the positive impact data that was shared with the Insights report was not necessarily a surprise to CEF. We currently have an internal team that is solely focused on collecting social data, speaking to clients, hearing the client impact on a daily basis. And we also have a dedicated social performance team. So what that means is that on a continuous basis, we are actively collecting stories of impact from our clients. We're actively measuring and tracking that impact data. So by the time we get into conversations with our lenders, it's very easy for us to kind of communicate all of our impact data, communicate all of the work that we're currently doing within CEF. So how this stands out as a competitive advantage is that when investors are looking for who they want to invest, we typically attract social investors. So investors who are already focused on looking for organizations who are focused on impact, looking for organizations that aren't necessarily only focused on the financial metrics. So over the years, because CEF is so focused on social impact and it's embedded in a lot of our operations, it's embedded in our different policies, as well as in how we do our work on a ground level, it has helped us over the years build a reputation in social impact. So from inception, all of the investors that SEP has had have been focused on social impact. And that means that when other investors start talking to each other, or not even investors, lenders rather, speak to one another, the name of SEF is typically suggested as a industry leader in social impact as well. So yeah, that's how a lot of this impact data gives us a competitive advantage. And with a lot of the social investors, typically they are wanting to have proof that you're not just saying that you're a social impact organization or saying that you're focused on social outcomes. They want proof of that. They want proof in how the organization is governed. They want proof in how that data is collected, that data is analyzed, and how it's actually informing decision making. So at least with SEF, we align ourselves with the Universal Standards of Social Environmental Performance Management, which impacts a lot of our operations, impacts our policies. We also, something that really stands out for SEF is that we have a board social performance committee. And that's something that provides a lot of credibility in terms of our focus on social performance. To say that we're not just collecting the data, we're not just showing it for investors, but it is influencing at a board level, at a very senior level, a lot of the decisions that we're making in an organization. So just going into the second question, how our impact-focused investors support us. So as I mentioned before, our lenders are really focused on social impact. So really what we are finding at SEF is that we are joining hands with them. So we have our goal of social impact, and they have their goal of finding organizations that are focused in social impact so that they can put their money where they know that they're not just only going to get the financial returns, but they're also going to get social returns. So really what it is, it's joining of hands between us and our lenders, as opposed to our lenders kind of asking us, do this, focus on this, focus on this. Because SEF already has a social performance team, because we have a board social performance committee that's solely focused on this, it's not necessarily a push and pull, it's more a joining of hands together as we walk. But another thing that at least helps us internally is that because we align with, as I mentioned before, the Universal Standards of Social Environmental Performance Management, with the climate protection pathway, we understand and we are very much aware of the industry standards in terms of the regulations, what is expected. And not only do we understand that, but as also demonstrated, for example, in the 60 decibel in the report, that typically we try to go above and beyond that. So what it does is that it makes things easier for both our investors and for us in that they are able to trust that we are saying what we are saying about social impact.
Thank you for that, Lebo. Yeah, I think this is very interesting. I think hearing from both you and Calum not only reinforces the importance of having defined series of changes and like matrices through which we look to both design our work, but then also measure them, but also the importance of having them be standardized across organizations. So there is a sort of common good that we're speaking to. I see there's questions coming in. We'll just get to that in a second. I just want to go to Cynthia now. Cynthia, BRAC Liberia has been a part of the index since 2022. So we'd just love to hear from you on what was it that prompted you to come on board an effort like this? And as somebody who's been a repeat participant for the last 4 years, how has your use of the end client data and insights sort of evolved over these last 4 years, both in terms of how you sort of interpret them, but also how you've applied them to your organization?
Okay, thank you very much for having me. My name is Cynthia Oyarbo. I work as a social performance management champion at BRAC Liberia Microfinance Company Limited. I'm so honored to join this panel today. I would firstly like to start with a brief introduction to BRAC Microfinance for those who may not be familiar with our organization. BRAC International Microfinance operates in 8 countries across Africa and Asia. We are currently serving over 980,000 clients, currently serving over 980,000 clients. 98% of those clients are women, and over half of our clients are live below the poverty line of USD $5.5 per day, and over half of our clients live in the rural area. So our program has built over 40 years of experience in Bangladesh, where we serve over 14 million borrowers, 90% of whom are women. And then coming to Liberia, BRAC Liberia Microfinance Company Limited was founded in 2008. And it is now the largest microfinance provider in the country, reaching out to over 100,000 clients through 55 branches and within the 15 counties in Liberia. Our mission is to provide a range of financial services responsibly to people at the bottom of the pyramid. We particularly focus on women living in poverty in rural and hard-to-reach areas to create self-employment opportunities, build financial resilience, and empower women economically. For us at BRAC, impact is our bottom line. When we deliver real value to our client, business perform naturally. So the surplus we generate from the business is reinvested into our program to enhance product and services, also to strengthen client awareness through financial literacy, and we also use that to expand our business in the rural area. So financial sustainability is what enables us to actually drive impact year after year. Then another thing I would like to highlight is that access is one of the most important factors for the client we serve. We provide access to responsible inclusive finance for people, especially women who are excluded from the main financial system, who rely on costly and risky sources like money lenders, like loan sharks. Another thing is that when it comes to our pricing, we are competitive and in line with other MFIs. So from the Lean Data Survey, we got to understand that interest rate is not often a concern. But what our client cares about more is how quickly they can access the loan, whether they can borrow a large amount to grow their businesses and support their families. So now you have gotten a bit of insight from BRAC Liberia. I will now go directly to the questions that were next. That has to do with how we have used the data and what prompted us to come on board. To answer that question, I would like to say that our relationship with assisted Decibels actually began before the index was launched. BRAC has been using the Lean Data approach since 2009. So we found it extremely valuable because it helped us or it gave us a quick and actionable insight directly from client. So when the microfinance index was launched in 2002, BRAC Liberia or BRAC was very proud to be one of its founding members. We also use that data the data allow us to benchmark our performance, both in BRAC countries and other MFI within the region. So for example, in one of the metrics, we felt that our score was initially low. Like, for example, net promoter score, we were around 64% in 2023. So, but when we compare our results with the regional norms, we realized that we were actually at the same level at the market average. So then we were able to redirect our focus from just the net promoter score to another metrics where we were actually underperforming, like the quality of life. But then in 2023, our score was around 31%. So we redirected our focus in that area. So now you can see in 2024, our score has improved. Okay, coming to how we use the data. For the past 4 years now, we have moved from just simply collecting data, but we collect the data and we really use it to drive decisions. Okay, now we are able to segment our data deeply by region, that is rural and urban, by new and old our client, by age, especially age 18 to 35. By segmenting our data, it helps us understand whether we are reaching the right people and how their experiences differ. Another thing we also do is that we also use client feedback. We use client feedback to make operational changes. For example, clients asked that they wanted bi-weekly instead of weekly payment. They needed higher interest, higher loan ceiling. We were able to address those feedback from client. So from that little adjustment that we were able to make, we observed that our client satisfaction has increased greatly, and the relationship has also improved. And also in 2022, we asked our clients what topic we can use in the financial literacy training. So from their suggestion that they made, we were able to design our curriculum. And then in 2024 results, we saw that clients can now manage their finances better. They can now save more. They are now more confident. So the greatest validation is to listen to client. So by listening to client and doing what client wants us to do has improved our operation greatly, has had a greater impact on the client that we serve. So to conclude, being a part of the 60 Decibel Index made us more client-centric and data-driven. It helped us to listen better, to act faster based on your request, and then to measure the real impact for the people we serve. So for BRAC, I would like to say, we learn by doing. Thank you very much.
Thank you, Cynthia. That was very interesting to hear. Okay, now let's dive into the questions. I think there's a few questions that have come in from the audience. There were some that were shared on the registration. So just as a starting point, and I think this question has come up for Calum on chat also, and Cynthia answered some of this from the BRAC perspective, but you just would love to hear from Calum and Lebo, which is basically, what are institutional responses to insights from the index and from this kind of study? So for Calum, I guess specifically, if you can give examples of which areas that you've expanded work in based on the data insights. And Lebo, I'll just throw to you after Calum in just hearing how, what concrete actions to improve impact is that maybe not just from this data, but just like you spoke about social performance data that you gather. And then we can move into some of these other questions. Calum, over to you.
Thanks, Atul. So just on the question about example of areas that we've expanded into based on the data insights. So if I have time, I would give two answers to that question. Firstly, where our partners that are part of the survey are performing well, either in outreach, outcomes, or client protection indicators, the data can support a case for further investment in those partners. So it's been part of our decision making. At the same time, I'd also say it's just one consideration in those decisions. It's not the only driver. And we're also not using the results for our partners in a punitive sense. So we wouldn't disengage from a partner based on these results. Where there are weaknesses or areas of lower performance versus the benchmarks that 60 Decibels publish. We see this as being more about understanding what are the priority areas where we can work together, and where can we support partners in terms of improving performance. And that kind of takes me on to the second answer I'd give, which is that the data helps us tweak the areas that we're already working with partners on. Atul, you talked about the finding around digitization as being one of the key outcomes from this year's data. Digital-only services have lower client satisfaction, lower net promoter score, and weaker impact outcomes. This is something we've been working on with our partners in Indonesia in the last year. We actually ran focus group discussions with 2 of those partners earlier this year. And, you know, as you said, I think the important thing here is that we're ensuring that these services are tailored to the needs of those communities specifically. Those focus group discussions were informed by last year's 60 Decibels survey results. And you know, going forward, we're very conscious of the importance of a hybrid model and the benefits that the clients get from the face-to-face contact with the field staff in Indonesia. So yes, the individual partner data and the overall data from the study influences how we work with our partners.
Thanks for that, Calum. That was wonderful to hear. Now, Lebo, over to you. I think one is we'd love to hear sort of what concrete actions data like this enables for your organization. And the other thing, I think one of the questions that was asked in chat was, as an impact-driven MFI, you know, how do you sort of balance growing for business prospects with the realities of client protection or over-indebtedness or over-borrowing? Like how should that balance be maintained?
So I think that was, I really appreciate the question that was provided in the chat, because I think it connects very well with one of the significant findings that I think was very significant, at least for SEF, and it's regards to the repayment burden and the question related to over-indebtedness. So just as a bit of context, within South Africa, is that a lot of the population is quite over-indebted. We also have a rise of what we call payday lenders, who are now almost branding themselves as microfinance institutions. So, you know, defending microfinance as an industry and proving that we are, as an organization, extremely dedicated towards preventing over-indebtedness of our clients is something very central to us. So the 60 Decibel insights that said that 79% of our clients mentioned that they did not experience a repayment burden from our loans, I think was something that was very significant, and also linked to a lot of the conversations that we were currently having internally regarding preventing over-indebtedness of our clients and how we as an institution measure that. So I think I'll just move into the question that was given. So Aditya asked, in this time when many MFIs are growing for business prospects, what is the way out for overborrowing, and what should an impact-driven MFI do to cope with the situation of over-indebtedness? So at least for SEF, what we do is that we have group lending, and what the group lending does is that it ensures that the other members within the group, the group of 5 women, are able to vouch for the other one. So they know who they are in the community, they know whether they have different debts in different areas, so they're able to vouch. But what is unique to SEF is that we also measure a client's ability to repay their loans and whether a client is over indebted by using our own unique methodology, which has been tested over time, and it's savings and 2%, 2% savings and business values. So what we do as SEF to measure whether a client has the ability to repay their loan is that we look at the percentage of or we look at rather whether a client was able to meet 2% of their loan, so save that amount. And then we also look at the business value that a client has. And what we're doing there is that we're proving that a client is able to not only repay their loan, but they have enough business income to then put money into their business and grow their business. So we're seeing that they're able to pay their loan and they're able to grow their business over time. And then also that they're also able to put aside money within savings. And this is a little bit contrary to, I think, a lot of the other MFIs, which typically look at, I think they do cash flow analysis. So what we found over the years is that this works better, and specifically in a South African context, where a lot of clients and a lot of people within the rural areas, which is where we operate, they're able to get loans from loan sharks. And these loan sharks aren't registered on credit bureaus. They informal loans. So what we have is that we're able to have a system in place where we're able to capture the loans that are not formal by the fact that the other group members are able to vouch and say that, no, this client who is in my group got a loan from here, here, and here. So we've provided an alternative way of really measuring repayment capacity and ensuring that our clients are not over indebted, even in the hidden debt, which is what we could call it. Yeah, so we use these different ways to make sure that, you know, we're not over indebting our clients. But we also, because as I mentioned before, we have a dedicated social performance team. So we're continuously asking clients, you know, do you have other loans with other institutions? Is this your only loan? How are you able to repay your loan? And we're constantly asking clients that what are the ways that you're repaying your loan with to ensure that they are using income that is sustainable, that we're not over indebting our clients.
Thank you for that, Lebo. There's actually a related question that's come up that maybe Lebo, you and Cynthia can sort of speak to, which is especially when you're doing things like group lending or working with women in rural communities, how do you align sort of financial sustainability with that? And also, what are the risks or limitations that can make this type of liability challenging? And how can sort of models be designed to mitigate those issues? But yeah, either of you, if you want to jump in, please do go ahead.
So I mean, group lending is some of the challenges that we've experienced with group lending is that we do have patching, which means that if one member defaults on their loan, obviously, then the other members are not able to continue and get another loan without repaying that loan off. So it's a double-edged sword, because on one hand, the positive benefit of that is that it significantly strengthens group solidarity. And as more and more people coming out of the rural areas, as we're seeing social solidarity as a society breaking up, it's very important to strengthen that. But on the other hand, we have in the past had a lot of complaints from clients about patching, about having to repay a loan from another member and they don't want to, and that's not why they joined SEF. So what we've done as an organization is that we've really focused on strengthening the what we call the first group recognition, which is when clients first join the organization, we ensure that they know each other, that they all live in the same area, that they are all aware of each other's businesses, right? So that they know where the other person is stocking, they know what the other person is doing in order to repay their loan. And then that there's no like family members. So what we've been doing is that we've been also focusing on trying to strengthen their understanding of basic understanding of business when they first come into the organization, so that they have a sustainable way of repaying their loan. So by ensuring that the clients that are coming in understand the mission of SEF, understand why they're receiving that money, right? So that it's not just to spend on the household, which, as you mentioned, has positive impacts. But long-term sustainability means that we need to have some type of income-generating activity. So now we've started to train them and strengthen that to ensure that they understand how they're going to be able to repay their loan, and they understand that a loan is not a blessing, it's a responsibility, and that they need to have a responsibility within themselves to be able to sustainably repay their loan, so that the whole group as a whole is strengthened. Yeah, so lots of pros and cons of group lending, but that's been how we've kind of tried to navigate those challenges.
Thank you, Lebo. I know we're at time, so just to close, there's one question that came on registration that I think is interesting. Calum, we'd love to hear from you on this, and then any other closing thoughts, and then we can wrap up. Before we get into this, for people who have to drop off, this whole session is recorded, and we'll be sharing a link of this recording right after, so you can go through all of this later. So the question is, I mean, and it's effectively something I think that all of you might have a point of view on, which is that given the growing pressure on things like climate resilience, inclusive growth, digital transformation, and just the sector as a whole changing over the years as first-time access starts to drop, etc. How should we think about how measurement frameworks need to evolve over the next few years? Like, what is there a change that's needed in how we look to understand how we collect the data and use the data? So, Calum, any thoughts from you, Lebo, Cynthia, and then we can wrap.
I guess the first thing I would say is I think this survey is an opportunity to develop the way that we collect data. As I said at the start, we've been part of the project since the first year, and we've seen how the 60 Decibels team have consciously taken the data each year and looked at how useful is this, both for reporting in terms of decision making, and the survey. Of course, we want to have consistency from year to year, but also I think there's a real value in how those questions in the survey have evolved in each of those years. I think the data we get from the survey now is better than it has been, and also the module approach has allowed us to test out climate resilience questions, climate protection questions as well, and I know. I'm sure it's not giving too much away, but I know 60 Decibels are thinking more in terms of new modules and improving the coverage of the survey that way in future years. So I think it's something that this definitely contributes to.
Great, thanks for that, Calum. Cynthia, over to you. Any, and maybe not just as 60 Decibels, right? As a sector, just like how we need to think about measurement going forward as things like climate resilience and digital transformation become more of a priority. If you have any thoughts, we'd love to hear.
Okay, so thank you very much for the question. Well, actually, the Lean Data Survey has brought a great of value to BRAC. We are also thinking not only measuring the impact from 60 Decibels every year, we also try to incorporate that in our own system where we can be able to track some of those data too in our operation, not only rely on 60 Decibels, even though we're going to get we're going to be a part of the 60 Decibel index or the survey every year, but we also want to understand it from our point of view, from our side. So we are trying to also incorporate that in our operations where we can be able to measure the impact that we are also reaching out to clients.
Excellent. Lebo, any last thoughts from you on how we need as a sector to evolve our impact measurement frameworks? Yeah.
Thank you. So I think as the world evolves, they start becoming more focused on a lot of what you said, climate resilience, environmental aspects, digital transformation. I think it's very important for us to center the voices of our clients, because a lot of times, often we can just kind of go with the flow when lenders or investors are starting to ask you certain things. But it's important as MFIs and FSPs for us to always pause and ask what is really beneficial to the clients. What are they actually asking for? So even if they're asking for perhaps green finance or anything like that, it's important for us to not just do, but to first listen before we act.
Well, I think that's a wonderful note to end this on. Like this index has always been about listening to our clients directly. Thank you everyone for joining and listening to us for the last hour. We hope this was useful. Like I said, the recording will be shared. And thank you, Calum, Lebo, and Cynthia for attending and sharing your extremely valuable insights. Thanks, everyone.
Thanks, Atul. Thanks for the chance to join. Thanks, everyone.
Thank you.
Thanks, everyone.